a small village called Harhua, on the outskirts of the ancient city of Varanasi, India, Irawati Devi stands proudly under the bael tree that shades her home. Goats move around her mint green food carts in search of traces of the fried noodles and samosas she sells. Irawati, a 58-year-old, remembers wrapping saris around bamboo poles when her family first moved to Harhua, as they could not afford to build walls. With one small loan after another, averaging $290 at a time, she eventually was able to replace her home's makeshift partitions with brick walls. She then bought the food carts, pots, and utensils to start the business that now supports her family. Millions of people across India can relate to Irawati's story of using small loans to lift herself and her 7 children out of poverty. Lending to microfinance borrowers, primarily women in rural areas, has gone from $2 billion in 2012 to $20 billion in 2018, an increase of 900%. These funds have enabled millions of marginalized families to start and expand businesses, purchase essentials during emergencies, and support their children's education. This extent of growth in reaching women in rural areas of India has been made possible by the advances made by the financial technology, or FinTech, industry. In particular, mobile banking greatly contributes to this level of success in reaching out to women in need in remote areas of India. Through bank agent networks, people can now operate bank accounts through cell phones, not even smartphones. The bank agent network has been the fastest growing development in microfinance in the last 5 years. The first automated teller machine in America was introduced to the public on September 2nd, 1969, at the Chemical Bank in Rockville Center, New York. It started initially dispensing cash to customers. From then on, it went on to revolutionize the banking industry, eliminating the need to visit a bank to conduct basic financial transactions. By the 1980s, these ATMs handled many of the functions previously performed by human tellers, such as check deposits and money transfers between accounts. This saved a significant amount of time for the customers, as there was no longer a need to commute to the bank, wait in lines, and interact with the bank teller. This was just the beginning of this revolution that would transform people's lives for the better. Financial inclusion has been increasing across all demographics over the last few decades. In 1989, 86% of US households had a bank account. This value increased to 93% in 2013. Furthermore, 56% of US households in the bottom income quintile had a bank account in 1989. This value rose to 79% in 2013. In addition, about 65% of minority US households, including Hispanic and non-white households, had a bank account in 1989. This value reached 87% in 2013. Financial inclusion has also increased across all geographies. The South is still behind other regions, but the difference has reduced. The FinTech industry has had tremendous growth in recent years and could potentially increase access to or diversity of financial services to both households with a bank account and those without. Basic banking relationships make up the financial foundation of most households. However, lack of access to mainstream financial services reduces the ability to build wealth and generally live a financially secure life. Banking relationships allow for the establishment of savings, along with a payment and credit record. Limited access to credit can damage the formation of small businesses and general community development. Those who cannot or do not access traditional financial services frequently turn to more expensive alternatives such as payday lending, car title loans, and pawn shops. Over a third of low-income adults have no credit card. Researchers have identified the lack of a credit card as a common factor among homeowners subjected to rapid foreclosure, which happens with a single missed mortgage payment. Ultimately, maximizing the number of people who use conventional financial services is critical to the well-being of not only those individuals and their households, but also the broader economy. Credit is essential for small business, communities, and commerce. Lack of credit on fair terms can deprive the economy of jobs and innovation. Originally, credit cards were introduced in the 1950s, which eliminated the need for consumers to carry physical currency. This was the first of the FinTech products. This evolved further until the internet was born in 1995. In 1998, PayPal was founded, representing one of the first FinTech companies to operate primarily on the internet. A breakthrough that has been further revolutionized by mobile technology, social media, and data encryption. Before the creation of such companies, small businesses sometimes had trouble accepting credit cards due to high fees and difficult-to-use equipment. These companies provide an easy-to-use process that allows businesses to accept payments, print receipts, and offer virtual gift cards to their customers. Customers also have a large degree of security. In the past, small vendors would take customers' credit cards and make copies of them. That posed a serious security issue, and customers would have unknown use of their cards after such transactions. Overall, the benefits of going cashless are numerous for all consumers. Problems associated with liquid cash, such as losing cash, having cash get stolen, having to go to the bank or ATM to withdraw money, and keeping track of spending are no longer a concern. In cashless mode, all transactions are recorded. Excellent reports are available online as part of account management. FinTech has made it possible for investors to manage their investments without the traditional manual intervention through financial advisors. This is through the use of a FinTech robo-advisor technology, a FinTech platform that helps its users by automatically investing their money and providing financial advice based on their goals. Robo-advisors use computer algorithms and special software to build an investment portfolio without input from a financial advisor. The software automatically invests and rebalances investments based on a user's needs and goals and market conditions. Companies using this robo-advisor technology offer automatic rebalancing, daily tax loss harvesting, and other services rooted in automated investing, which can benefit investors by making their investments easier to manage without the traditional manual intervention. Because of FinTech, the common person can have much more access to investing in the financial markets. There are many apps that facilitate digital stock trading. Previously, most investment platforms would charge high fees to their customers, even though executing trades doesn't cost much. In response, many companies launched fee-free trading platforms, allowing smartphone users to trade stocks more freely. These services offer commission-free stock trading and exchange-traded funds. Some companies have also recently started offering cryptocurrency trading for their users. The benefits of such services are many, including free trading, the availability of robo-help, and knowledge. With the availability of the internet and these services online, most people around the world can trade and invest. Previously, each trade would have to go through a broker and would cost $20 per trade. But now, with the availability of the internet and these services online, most people around the world have the ability to trade and invest. By investing in safe choices, the common person can hope to grow his or her money and monitor the growth online. FinTech companies have promised to create positive social impact through financial inclusion, allowing the FinTech industry to see significant growth while also garnering more impact-related investment funds than any other industry. In 2021 alone, equity funding raised by FinTech companies around the world almost doubled. To date, FinTech companies have a collective global market value of approximately $5 trillion, and industry growth is expected to exceed 23% for the next 5 years. This growth is driven in part by FinTech's potential for social impact at scale. FinTech executives promise to expand financial inclusion to the unbanked, or people who have no accounts in any financial institution, while strengthening financial health and fostering digital security. Companies such as PayPal, MasterCard, Visa, and Shopify are embracing this promise, positioning their products and services as tools for financial inclusion and equitable economic growth. Investors are also embracing FinTech's impact potential. The industry currently receives around 1/4 of all impact-oriented investment, more than any other industry, and representing nearly $250 billion in assets under management. The FinTech industry has increasingly become synonymous with impact potential. Those in poverty face poor access to financial services because of high costs, lack of credit, and perceived high risks and costs to financial institutions to service these persons. FinTech is changing the landscape by reducing the cost to acquire and serve clients. The marginal cost of mobile payments has fallen to effectively zero from what was traditionally a high fixed cost. Digital lending and rural e-commerce have enabled farmers to get loans and secure higher prices for their produce. The access to financial services also helped many low-income earners get government subsidies and stimulus packages during the COVID-19 pandemic. The World Bank and the International Monetary Fund note that financial inclusion is a building block for reducing poverty and for improving options for greater equality and distribution of the rewards of economic growth. China, India, and Kenya have demonstrated that FinTech is the last mile solution for financial inclusion. Kenya's M-Pesa, China's WeChat, and India's Paytm provide financial services via smartphones to millions of families. The World Bank Group is using FinTech to achieve greater financial inclusion, thereby accelerating economic growth. One particular area where the World Bank Group has been focusing its efforts is on the gender lens and the difficulties of micro, small, and medium enterprises, or MSMEs. For example, in India and in Ethiopia, the World Bank Group is supporting women-led MSMEs, primarily vendors, seamstresses, or marginal farmers, in using digital platforms. It is collaborating with the governments and FinTechs on the ground to develop an application to encourage digital literacy, while delivering targeted business insights and advice. Furthermore, this data, along with other alternative data such as repayment of store credit and collaborative behaviors, will contribute to a credit score, providing a path to access to finance for those without formal credit histories. The use of alternative data is becoming increasingly common in several other countries, from Chile to Sierra Leone, where innovative solutions harness the value of transaction data from e-commerce and payment platforms, mobile phones, or even social networks as alternative sources of information to assess creditworthiness. This is financial empowerment in action, especially when combined with measures to protect consumers and financial education to prevent over-indebtedness. The role of technology in finance is definitely leading to the betterment of people's lives in a myriad of ways. It is making the whole world a flat place. The invention of the internet and all of the applications that run on it has made it possible to learn about financial tools, invest, and have access to more freely available knowledge. Poor people in many countries are able to get loans over mobile apps and work on their businesses. Overall, there's a tremendous saving of time for people who are able to manage their bank balances and retirement accounts and invest all from their mobile phones. In busy and fast-paced times, this helps bring some free time and balance to their lives. In short, FinTech is disrupting all areas of finance: banking, loans and lending, insurance, personal finance, wealth management, and cryptocurrency. The number of people unbanked is reducing at a fast pace. All of it is benefiting people from all walks of life. FinTech is the seed for change, and the growth is dense, lush, and rapid. Thank you.